Again, my name is Joey Rice. I'm with Associated Insurance Management. So we're going to go over today. We're going to go over the state of the insurance market. So, Amir, if you go ahead and click to the next slide. So the general overview. So I want to start with kind of explaining the difference between a hard market and soft market, and then we're going to go into what drives those different markets. So in about 2014 till about 2019, 2020, the insurance market was relatively soft. Premium increases were pretty stable. There was a lot of insurance companies that were willing to offer quotes for different products. But what happened was COVID hit, and the market turned hard. So we've been in about a 3-year cycle of a hard market that started shortly right after COVID hit. So I want to go into exactly what drives, a hard market relative to a soft market. So those would be reinsurance costs, market capacity, general inflation, and then general social inflation, legal costs, and increased average summary judgment. And also we'll touch on the Surfside collapse and how that affected the insurance market as a whole as well. Next slide. So reinsurance. So reinsurance costs, essentially insurance is essentially a gamble, right? So clients purchase insurance from insurance companies, and they are taking on the risk of having to rebuild a building if it burns to the ground, right? That being said, if you insure your building, let's say your building is $20 million and Greater New York or Berkeley or Travelers insures your building for $20 million, there's maybe a misperception that GNY is insuring your building for $20 million. They technically are not insuring your building for $20 million. What they're insuring your building for is the first few million. And what they do is they actually go out to a reinsurer and they purchase reinsurance to take on the excess amount of risk over that first million or $2 million, depending on the size of your building. And they have to go out and buy that reinsurance. What happened is that the reinsurance rates, due to the natural disasters throughout the country, skyrocketed shortly after COVID due to the increase in materials and construction costs, what we'll get into. But what really happened was the increased cost of the reinsurance rates have a negative impact on the primary insurance rates, because the primary insurance rates can only be a percentage of the premium. Once it gets over that certain percentage, the account can no longer be affordable because the reinsurance costs outweigh the cost of the actual premiums themselves. And how that affects Washington, D.C. is these reinsurers actually insure properties all across the country. So when you see a natural disaster in California or Texas or Kansas and Florida, what that's doing is that's taking a hit on the reinsurers that are providing the rates to companies that also write business in D.C. Next slide, Mir. Oh.
Sorry about that, Joey.
No worries. All right, market capacity. So this is a downstream effect from reinsurance rates. So reinsurers have their own underwriting guidelines that they require their primary insurers to meet, and those have tightened. Okay, and they've also tightened in the sense that not only have the reinsurers rates gone up, the primary insurers are actually having to take on a higher percentage of that first portion of the risk. So for example, if companies like the smaller mutual companies like Hartford Mutual or Miller's Mutual that originally were insuring the first million, they're now being required to take on the additional second $1 million in coverage. So that is a much higher risk for the mutual companies that have a less reserve capital compared to larger insurance companies. So that's done is that's forced them to restrict their market capacity or restrict their underwriting guidelines. So what's happening is these insurance companies are looking at the risk with a lot more scrutiny. So older buildings with lack of updates are taking the biggest brunt of the hit from a market capacity perspective. So companies are no longer wanting to write older buildings that have a lack of updates. So we'll go over this later on when we go on what can be done to make sure that you put your building in the best position possible to remain insurable at the best cost. But buildings that are older than 1990 are the ones that are taking the biggest brunt of the hit. Anything over 25 years of age is considered an older building by insurance market standards. And again, this kind of goes into that older building, but buildings that are non-sprinklered are having a large are having a negative impact on having a market for insurance companies that are willing to quote them, mostly due to the life safety issue. So buildings that are in excess of 6 stories, it's actually an issue from a liability perspective more than a property perspective, because most of the non-sprinkler buildings that are high rise are concrete construction. But if you have a building that's non-sprinkler at 7 stories, you have a much higher probability of people not getting out of the building in the event of a fire, which could potentially result in severe injury or death, which would result in lawsuits. So buildings that are non-sprinklered are a higher liability when it comes to liability coverage relative to property coverage. Less favorable construction. So there's different construction that is used to develop buildings. So you have anywhere from frame to fire resistive construction. So the frame buildings are wood frame, where the fire resistant buildings are concrete, right? So concrete buildings are going to burn at a much slower speed than a wood frame building would burn. So buildings that are frame construction are having a much harder time finding a market to quote them, because the market capacity for frame construction has shrunk significantly. We went into briefly that the smaller companies and a lot of the other companies cannot afford the reinsurance costs. So what they've done is essentially, if the building is over a certain limit on a replacement cost basis, they can no longer afford to quote because they cannot no longer afford the reinsurance costs. And then regulations that prevent the ability to obtain enough rate. So in the admitted marketplace, insurance companies are actually regulated in the sense of they cannot charge more than the filed rates, which is actually can be detrimental to insureds, because they are unable to charge a rate they need to be able to afford the reinsurance costs and feel like they can be profitable on that individual account. So what that means is they can no longer afford to offer the insurance, which is detrimental to the actual insureds themselves, the community associations, because if they could charge more, there'd be a less probable chance that client would end up in the non-admitted marketplace where the rates are unregulated, but the premiums are significantly higher, which we'll get into later in the presentation. And then the last piece is crime score. So unfortunately, as a whole, the DC crime score is relatively high, which goes into consideration when insurers are looking at quoting accounts. So these are the main driving factors that have really reduced the market capacity for community associations as a whole. Go ahead, Mir. Inflation. So inflation has really been the crux of the main issue with regards to the hard market. And a lot of that has to do with the fact that the claims themselves have gone up significantly just due to the construction of the construction cost of the materials. So there was a misperception that the most recent hurricanes in Florida were the most destructive, which they were. But the reason why they were so destructive was because the cost of materials has gone up so much. And that's why the cost of the actual hurricanes were so high within the last 3 years, is because of the cost of materials have skyrocketed. And what really has driven that is the fluctuation in material costs, the supply chain disruptions that we experienced during the COVID, labor shortages, and an increase in labor costs were the main driving factors with regards to the increase in the construction costs. What also happened was that actuaries price out future premiums based on what they expect to pay out in claims. Unfortunately, due to COVID and the response to COVID, the inflation was so great and so quick that the actuaries had priced their models based on general inflation, but not on the actual inflation that they experienced due to the unknowns of COVID. So the insurance companies, what you've seen is they've tried to play catch up over the last 3 years with their significant increase in insurance premiums. And then what also has happened in accordance with the having to catch up on the premium side, the building replacement cost values, which is essentially what drives the insurance premiums, the buildings have now become undervalued because of the increased costs in materials, which has caused the building limits to need to be adjusted quickly at a high percentage. So what we're seeing is a perfect storm of having the premiums increase due to the underpricing due to the actuaries and inflation, and then the increase in the building values, which is the driving factor with regards to the insurance premiums, which is why we've seen such a hard market over the last 2 or 3 years.
So Joey, just because I'm having a little trouble following, I think what you're saying there is historically buildings have been undervalued, right? And we're playing a rapid catch up.
Well, so for example, they haven't historically been undervalued. So let's
Okay.
say in 2019, your building was insured for $10 million at $200 per square foot. It's
Mhm.
now, after 3 years, $300 per square foot, which is a 33 or 35, 40, 34% increase in the building value. So
Okay.
theoretically, the insurance companies are want to get rate increases of 10 to 30%. And then you also have this 34% increase in your building value, which is also a rate increaser on top of the rate. So
Okay.
you have the perfect storm of having to increase the buildings to account for that 33% increase in inflation, and then also getting the premium increase just to keep up with the claims.
Got it. Okay. Thanks.
Yep.
Probably next slide, right?
Yep. So legal costs and increased average summary judgment. So a lot of this also has to do with inflation and social inflation. So unfortunately, what we've seen is a desensitization in larger verdicts. So umbrella policies, which we'll go in later, where you have a primary general liability policy that provides typically anywhere from $1 to $2 million on a per occurrence basis. Those limits are getting exhausted at a much higher percentage due to the larger verdicts that we're seeing in the legal climate. So what's happening is the umbrella policies are coming into play much more often, which is driving up the market premium for umbrella policies, and it's also restricting the underwriting guidelines for umbrella products are becoming far more restrictive, which we'll get into later in the presentation. It's also the negative public sentiment to corporate accountability. There's polls done that 60% of jurors believe that public companies are not doing enough for public safety, which is driving less favorable decisions by jurors against corporations on legal cases. Erosion to tort reform. So what that is, what's happening there is in certain jurisdiction, what we're seeing is an increase in the statute of limitations and making it more favorable for legal attorneys to extend or become more aggressive with their lawsuits against corporations because the laws are more favorable to do so. And then the attorney tactics and legal litigation funding, which is a investment funding for plaintiffs, has become more lucrative, where on the defendant side is becoming less lucrative because with all the other factors that we have discussed, it's much more favorable to be on the plaintiff side than it is the defendant side at this point. Claimant side, excuse me. Go ahead. So the umbrella market. So we kind of briefly touched on this, but the umbrellas, the umbrella product is additional liability limits over top of your general liability insurance. So again, most community associations carry $1 million per occurrence limit, right? But let's say you have a 7-story building in DC and it catches fire and it's non-sprinklered, or it's sprinklered and the sprinkler system malfunctions, or a life system malfunctions, right? The association, and let's say multiple people were to suffer severe injury or pass away, $1 million per occurrence in DC, especially with how logistic it is not going to suffice. So what community associations need to do, if they don't already have it, is purchase umbrella coverage, which provides additional liability limits over top the general liability insurance. This marketplace has shifted dramatically. Risk purchasing groups were formed within the last 20 years. And what that did was it was an umbrella product that essentially offers very, very high umbrella limits for a very low premium. That market is drying up really quickly due to the social inflation that I discussed earlier. And what is also happening is those companies that are offering the risk purchasing groups are shrinking are restricting their underwriting guidelines to restrict buildings that are, again, non-sprinkler, that are more than 6 stories, and do not have a central fire alarm and don't have a 24-hour front desk with personnel with enunciator panels. So you would think that most buildings in DC would have one of three of these systems, but it's actually fairly, it's not super common, but it's fairly common to actually have one of these or to have your building not have one of these three systems. And if it does not have one of these three systems, it's now falling outside of the risk purchasing groups, which, if you can see in the slide here, is a far higher premium than the risk purchasing groups offer. So the typical rate for a $10 million umbrella under a risk purchasing group is about $2,500. Now, if you have to go to the standard market, which is outside of the risk purchasing group, in a lot of cases is now in the not admitted marketplace, if you don't have one of those three life safety systems, the premium on an annualized basis is anywhere from $15,000 to $20,000 a year. So you can see how much of a gap that is from a premium basis if you do not have one of these three systems. The downside of these three systems is that they are extremely expensive to implement. So that being said, it is within the association's best interest as a whole from a long-term pricing standpoint, because if you have to pay $20,000 over 5 or even 10 years, that cost will add up, which may not equal the cost of a central fire alarm system or 24-hour front desk personnel, but at the end of the day, it will cost that much over the long haul. So it'd be beneficial for the association, and strictly just from a life safety perspective, just to save lives as well, is to have one of those three systems if your building does not already have one of those three life safety systems. Go ahead, Mira. Property deductibles. So this is another response that we're seeing from insurance companies to mitigate inflation, especially the inflationary adjustments in insurance claims, is a lot of larger buildings, more than 4 or 5 stories. We're seeing insurance companies mandate a minimum water damage deductible of $25,000. So that's really, the higher deductibles are becoming the norm, because again, a $5,000 claim 5 years ago is now coming into $25,000 claim. So those $5,000 deductibles are no longer feasible for the insurance companies to carry and remain profitable. Because, for example, if you have a 30-unit building and you're paying $15,000 to $20,000 a year in insurance, and you file a claim for $20,000, you're already operating at 100% loss ratio for that year. Typically, insurance companies consider you unprofitable at a 60% loss ratio. So you can see how, and if you have one claim that happens within your unit that results in the entire flooring need to be replaced, that claim is easily hitting $15,000, $20,000 now. So that being the case, the insurance companies cannot remain stable and cannot afford insuring buildings with these lower deductibles now. So it's really important, and we'll get into this later with regards to the association's response, is looking at your bylaws and looking at the State Pacific Condo Act on what can be charged back to unit owners if a loss originates within their unit, to mitigate that deductible cost that is now being pushed onto the community associations by the insurance company. And we'll get into that later on with regards to the association's response to mitigate their insurance costs.
What I want to say, Joey, from a management standpoint, also, we've for years been trying to encourage associations to up deductibles to get rid of what we call these so-called nuisance claims, because it's very easy for you to say to somebody, well, we can't make the claim because it doesn't reach the level of your deductible. But as you pointed out, most places, if you have to do hardwoods wall to wall in a unit, it's going to be easily, without mitigation, which we all know is a cost, just the flooring can hit 15 to 20,000. So, but I wanted to point that out. And it's something that several of our associations are just now budgeting for. We're probably going to have a claim this year, right? Like, we're probably going to have to do something that we don't want to claim on our insurance. So I just wanted to drop in a manager tidbit there. So
yeah, absolutely. And yeah, you could touch on this too, Mira, but we always recommend to our clients is to, in the budget line item, add an insurance claim, just so you have that in there for at least one claim up to 25,000. So when you have that claim and you can self-insure, if it doesn't occur within a unit, but you still have to incur the cost, it's in your budget already. So yeah, that's highly recommended. Premium increases. So like I referenced earlier, The hard market's been going on for now about 2 to 3 years. And for the last 2 years, we've seen the average premium increase range from 10% to 30%, depending on the different factors that we had already referenced. And that accounts specific loss history. Again, if you were non-renewed, you had to go to the E&S market, we've seen premium increases up to 100 to 500%. So that 10 to 30% is sort of kind of the going standard market rate. And then unfortunately, we have seen in the first quarter, the renewals that we're seeing to start come in, we are seeing that pricing increases around 10 to 12%. I use 10 to 15%, which is lower than what we've seen the last 2 to 3 years. It's still closer to the double digit mark, but we are seeing a little bit of a slowdown with regards to premium increase because a lot of the building values, we're starting to get those kind of closer to the inflationary adjustments. So we're starting to see the premium increases fluctuate between the 10 to 15% instead of the 10 to 30%. So what can be done to mitigate claims and increase your market availability? So for your older buildings that are built prior to 1990, I cannot stress updates. So the 4 main building updates that insurance companies ask insurance agents on what has been done within the last 25 years are roof, electric, plumbing, HVAC, heating, and cooling. So those are the main items, building systems that insurance companies ask about with regards to updates. So it's really important, and I reference this in the next point, is looking at your reserve study and making sure that your reserve study is updated and making sure that you're complying and meeting your reserve study's demand on regards to when the building should be updated with regards to these systems. If the roof is older than 25 years, insurance companies look at that as a problem. If your electric is old, a lot of times the electric's does not need to be replaced to its entirety, but it's really important to do inspections to make sure that your electric systems are working properly. And a lot of the times the insurance companies see that as a real positive, that the associations are taking proactive action on their electrical systems to make sure that it's working functionally. I will note that there's 3 electrical systems that are huge red flags that essentially will kick any association from the admitted marketplace now to the not admitted marketplace in a lot of cases. And those are aluminum wiring, fuses, and Federal Pacific stat block breakers. If your building has any of those 3 systems, it's really important to look to get those mitigated and to get those retrofitted and to get those removed from your building. A lot of cases, the electrical systems within inside the units are the unit owner's responsibilities. That being said, this has a negative impact on the association's insurability. So boards really need to take proactive action on their best way possible to force unit owners to take action to address those electrical systems as much as possible.
And I can say real quick, Joey, I went through this with an association and what they did to kind of, and I don't know if it would still work because this was a few years ago, but they had fuses in unit. And what they did was state that anytime somebody did a major renovation or when the unit changed hands, they had to make the update. And that was enough to show, as Joey was saying, to show a proactive approach to it. That was enough at the time. And I don't know, the market wasn't as hard back then, but it was enough at the time for the insurance company to go, okay, they're working towards mitigating it. There's none in the common areas. And now they've taken steps to make it better in the units. So just a thought there.
Yeah, it is. And from a market availability standpoint right now, so if you have an account that has a good loss history, everything's fine, and you take it to market, but it has Federal Pacific stat block breakers, majority, if not all of the market's going to decline to quote you. So then you're stuck with that company that's still with you. And, if they increase your rates, you have, no other option. So it's just being proactive. If you can do it, just get them replaced now for the long haul is definitely the association's best option. Then wood burning fireplaces. This has become a little bit more problematic as the market has hardened. If the buildings do have wood burning fireplaces, and some of the older buildings do, it's really important to make sure that the unit owners are having their fireplaces inspected at least once every 6 months or once a year, and providing documentation and showing that they have been inspected and are in good working order. That's becoming a little bit more commonplace from an underwriter perspective with regards to insurance companies. And then, as I said earlier, reserve studies. You know, as insurance agents, I typically will always ask for the reserve study, because if I can find anything favorable within the reserve study showing the building's been updated or it's in good condition, I provide that information to the insurance company, because I'm not only selling insurance to insureds, I'm also selling the insureds to the insurance companies. So my job as an agent is to make my clients look as favorable as possible. So if you guys can make yourselves look as favorable as possible, it makes my job easier, and it makes it a much higher probability that I'll be able to get you the best insurance rates possible within the marketplace.
Well, that's a really good point, Joey. I want to point that out. Just have a conversation with your agent. Like that's absolutely. I think a lot of times the manager is relied on for that, but as the client, you have every right to pick up the phone. You know, board members, by the way, not just everybody, but I know Joey will speak to a board for me. You know, if there's questions or those kinds of things, and so I'm sure I don't want to volunteer too much of Joey's time, but if your association is insured by AIM, I know because I've had these conversations in the past with my boards that reach out, use your professional partner here, I guess is what I'm trying to say. Joey knows more about this than any of us on EJF staff. This is what he does all day, every day. So, you know, I do encourage the owners on the call or the board members on the call to definitely don't be shy about asking to talk to the agent.
Yeah, absolutely. Definitely. Yeah, and I'm happy to answer any questions. If you guys need me a call or you know, want my advice or anything, yeah, feel free. And then the number one way, outside of the updates to mitigate your insurance premiums is claims, claims, claims. So anything you can do to not file insurance claims will be in the financial best interest from an insurance premium perspective for the associations. And what we're seeing from a claims perspective is water damage claims for the first time within the last 5 years from a monetary damage perspective has actually tied fires. So what you're seeing is the amount of money that insurance companies are paying out for water damage claims is now equaling that of fire claims. Fire claims are typically on a one-off basis, way more severe, but water damage claims are becoming so frequent that the amount of claims paid in dollar amount is actually meeting that of fires. So water damage claims are the biggest burden right now from an insurance company's perspective. So if you have, let's say you have a 5-year loss history and you have one claim and it's a fire caused by a cooking kitchen fire totaling $100,000, and you have 3 water damage claims totaling $10,000 each, the insurance companies are going to look at the claim with the fire, they're going to look at the account with a fire claim much more favorably than they're going to look at a association that has 3 leaking pipe claims, because what they see there is an issue with an infrastructure issue and a frequency issue, where the fire claim is a human error issue, which is a freak accident, which is going to happen, but it's not an issue with the infrastructure of the building. So some of the best ways to prevent water damage claims, the one is water sensors. This has become way more commonplace. There are different type of water sensors that you can install in different types of models that are way more comprehensive, and ones that are less comprehensive that are more cost effective. But what they do is they don't prevent the water claim per se, but they prevent the water damage from becoming so severe that it becomes a claim. So water sensors are essentially fire alarms for water. So they go within all the units in the common areas, and then once the water hits the sensor, it makes a loud beep or it notifies a third party or an app or a system, which then tells you to turn off the water. So buildings that have owners that are out of time or have snowbirds that go to Florida in the winter or whatever the case may be, their unit, in a lot of these cases that we're seeing these claims, the unit's been vacant for some time and the water is just slowly seeped and seeped and seeped. And all of a sudden their flooring is damaged. It's going to the drywall, the floor below them. It's like a $40,000 claim now, where if the water sensor would have alerted them to shut off the water within an hour period, that $30,000 or $40,000 claim would have been a mitigation claim and maybe some flooring for $5,000. So what the association just did is they turned a $45,000 claim into a $5,000 cleanup that's not considered an insurance claim. Another thing that associations are doing water damage prevention programs. So a lot of claims we see: refrigerator lines, HVAC leaks. HVAC leaks is probably one of the most common, if not the most common. Dishwasher, things like that. The associations are putting together maintenance programs for individual unit owners as essentially a checklist or a responsibility on this is what you need to do on a monthly or annual basis to ensure your building or your unit is maintained properly to help prevent those nuisance water damage claims that we see so common. The amending your bylaws. So this is what I wanted to touch on earlier when we were discussing the deductible. So I know that certain people on this call are either from Maryland or Virginia or DC. So I'll focus on those three geographical areas. DC at this point, the DC Condo Act allows the association to assess the deductible up to $5,000 if a loss originates within their unit, unless the bylaws state otherwise. I've heard rumblings that DC is looking to amend that to 10,000, but that's not the case to date. But I've heard good news that they're looking to move that up to 10,000. In Maryland, it's 10,000. So Maryland's already at the $10,000 mark. DC is still at 5, and Virginia does not have any regulation with regards to that deductible amount. So they're really free under their bylaws to dictate whatever amount that they would be willing to do. Now, DC does have a caveat within their law that states unless that bylaw state otherwise. So a lot of my associations that have had problems with the water damage and have had forced deductibles put on them, either $50,000 or $100,000, what they're doing is they're amending their bylaws to allow for the assessment of the deductible in any amount outside of that $5,000 cap. So what it's doing is it's granting them a permission to increase more than 5,000 and not be subject to that $5,000 cap. Unfortunately, I have seen a lot of bylaws still in DC that have a deductible limitation, where it actually states that the deductible on the policy may be paid by the association or a unit owner, but may not exceed $1,000 in some cases, or 5,000 or 10,000. That's really handicapping the association, because in a lot of cases, the legal opinion that we're receiving is, well, the deductible is capped under the bylaws at 1,000, and therefore you can't assess more than 1,000 because the DC Condo Act states you can assess the deductible, up to 5,000. But if your deductible is less than 5,000, then you can't go up to that cap, which is granted by the DC Condo Act. Very litigious, and it's very kind of overwhelming and a lot of information. That being said, if you want to look at your bylaws and you want to make sure that you have the most favorable language with regards to the accessibility of a deductible against a unit owner. And then the last piece, if you're one of these buildings that are fairly old and you're more than 6 stories and you don't have one of these life safety systems, central fire alarm and sprinkler 24-hour, they're extremely costly. I'm fully aware of that. But from a long-term perspective, it's definitely something you want to look into, maybe budgeting down the road to help implement.
I just wanted to touch on, before we get off this slide, Joey, for preventative maintenance, you kind of focused on advising your owners of what they're responsible for, but I also feel it's my duty as a community manager on the call to also say there's common area stuff you may need to do. I manage an association that jets 2 tiers every 3 months.
Yes, yeah, jetting the tiers is great. That's part of typically water damage maintenance program.
Yeah.
Part of that is hydrojetting lines. You definitely want to talk to a professional plumber on that. There's different recommendations based on the type of plumbing that you have, how often you're doing it. So you definitely want to get a third-party professional opinion before jetting lines. But
the other little thing there is constant reminders about what you can and can't put down your garbage disposal.
Yeah,
it seems so basic, but it's
so common.
Yeah,
it's so common. Sewer drain backup claims are one of the most common insurance claims in DC.
Yeah. So anyway, moving on.
Okay, great. So this is so I want to touch quickly on non-admitted versus admitted. So I briefly mentioned this earlier. So let's say you have an account that has been non-renewed, and we go out to market and the market capacity is shrunk. No one will write it based on the underwriting guidelines. What happens is you no longer are eligible for the admitted marketplace. So now you've entered something called the not admitted marketplace, also known as excess and surplus lines, also known as the black market of insurance, right? So what the difference between an admitted company and a not admitted company is, an admitted company is regulated by the insurance commissioner. It has to file its rates. So it has to say, okay, this is what we're willing to charge based on this range of premium. So they file the rates, and it also falls within the state guaranteed fund. So if there's a claim that's open and that insurance company goes under and goes out of business, the state guarantee fund will actually pay the insurance company's loss on behalf of the insured. The non-admitted marketplace, which is which is regulated in certain situations, is not regulated with regards to the two factors that I referenced earlier, filed rates and state guaranteed fund. So what that means is they can charge whatever they want to charge based on what they think they need to charge based on the account's loss history and certain characteristics of the building. So what that means is we've seen premiums go up 100, 200, even 500% depending on the construction type of your building and how severe the claims are of that with regards to that account's loss history. So you really, really, really want to do the most you possibly can to help keep yourself out of that non-admitted marketplace. So that's either self-insuring claims, doing the water damage prevention, water sensors, and making sure that you're updating your building systems as much as possible based on your reserve study and based on professional inspections completed by third parties. So I'm happy to answer any questions anyone might have based on the information or anything else that you guys want to ask me relative to insurance.
All right, guys, this is the time. If you want me to take you off mute, you can raise your hand, or I've got the question window open. I don't see any questions yet. But I am happy to, like I said, unmute you and let you ask your own questions directly. Or we can all say that we've learned a lot and we don't have any questions today. So I want to thank Joey for not only the time today, but the time he took to put together this awesome presentation. And I think, Joey's, if Joey's not your agent, I suggest reaching out to your agents, or considering working with Joey, obviously. And then the only other thing, I think, Joey, we sometimes get this question about, whether people, like, when we're bidding insurance, I want to make it kind of clear, changing agents, you're still going back to the same underwriters, right? So aren't there only like 3, Joey, that are underwriting in DC now?
There's more than that.
Okay.
But it depends on the type of building. So if it's a high-rise building, and it's non-sprinklered and it's older, yeah, the market it's very limited. I mean, there's like 2 or 3 at this point that I even consider it, and the one is way more competitive than the other 2. So it's depending on, and then if you have a frame building, and that market is extremely tight. So it depends on a lot of the factors. But if you have a fire resistant building that's fully sprinklered, there is still a lot of insurance markets that I'd be willing to quote you. But how DC is, there's a lot of buildings that were retrofitted in the 70s, 80s that are non-sprinklered that are for high rises. So, but yeah, I mean, there's certain markets that we have that other agents don't have. So it would still be worthwhile sending it in to see exactly where you stand and what the type of characteristics of your building is to see if we can do something better. Because in a lot of cases we do.
Yep. We had a question from the crowd with what is a central fire alarm system? Is that just one that's
that's a great question. Or? Yeah, I should have mentioned that. Yeah, thank you so much for that question. Yeah, so the difference between a central and a local is a local system, and a lot of the older buildings have these. And you'll see them if you go in your hallways, and you'll see this is a local system. And why it's saying it's a local system is because if there's a fire, you have to pull the alarm. That alarm is not connected to the fire department. So why it says this is a local system in bold is because you need to call the fire department. So theoretically, why it's less favorable is because the response time for when the fire alarm went off to when the fire department is triggered is going to be theoretically more than if you had a central system, because the central system, once that's triggered by a smoke detector, that goes directly to the fire department and they're already on their way. So the response time is way faster with a central system than a local system. And a central system typically has annunciation panels, and it has where the fire is actually coming from. A lot of those central systems are way more comprehensive. For when the fire department gets there, they can respond much quicker than with the local system. Local system is extremely basic in a lot of situations, in a lot of circumstances.
Yeah, so a follow-up thought and question on that. 2 things. One, I want to point out that if you're considering certain renovations to your association, if you're a high rise, for example, and you're doing a new elevator, I ran into this. You have to get a central system then. So there's certain upgrades that may require you to come into code with them. So I just want to point that out. How do you get connected to the fire department? There's a phone line connected to the fire system. It's a certain kind of fire system, fire alarm system. And as Joey mentioned, most of them have annunciator panels. You see them at newer buildings when you walk in the door. Usually it's a big black panel that's got an outline of the building and it's got some lights on it. And what that does is when the fire department comes, they can look right at it and see exactly where the problem is. It's going to say that it's the 6th floor flow tamper, or, there's a smoke in the elevator at the 3rd floor. And so it identifies each item in the system and then assigns it kind of like a code. And so when it calls the fire department, it actually is sophisticated enough to say, we got a 6th floor smoke signal, or, those kinds of things. So that's the connection to the fire department. It does obviously requires a phone line, but it is in the actual alarm system that you purchase. So question. Oh, so yeah, Joey, the slide said something. It says we have a local fire alarm system with an enunciator panel in the lobby, but don't have a 24-hour desk.
Yeah.
And so how do we change to essential? That would be just working with the fire, like a Chesapeake Fire or one of those kinds of companies to get the upgrade, right?
Yeah. So in that circumstance, if you're just trying to comply, making sure you're complying with the risk purchasing groups, you'd either have to hire a 24-hour front desk personnel, or you would have to look into hiring, yes, a Chesapeake or a electrical or a life safety contractor or sprinkler contractor, and actually install the central fire alarm system. But I will be upfront. I mean, they are extremely expensive. It's not a cheap endeavor.
Right. But I also will say, conversely, if you have a problem and you don't have a system that has the right that is a central system that will alert the whole building, you can fall into what, I hate to say the words out loud because it happens, Firewatch, which is required by DC. When you have a problem with the system like this, or when you have an issue and and the fire marshal was made aware of it, where you have to have multiple somebody's 24/7 walking the building.
That's extremely expensive.
Yeah. I had an association that had to do that last year, and it was $15,000 because they had to have five people on site 24/7.
That's really expensive. I had clients pay $200,000 claims for that before.
Yeah. So, and DC's gotten a lot more strict about it. It used to be kind of okay, each board member is going to take a turn, but they actually have to now you have to have a certification with DC. You have to file a plan with DC. When they become aware of it, they give you, I think it's 12 hours to submit your plan for approval, and then it has to be approved, and they come by and check. They send people at random times. They came at 3 o'clock in the morning. They came at, 7 o'clock at night for us. But so just a thought on that too. So it is those systems, again, Joey's not lying. It is not an inexpensive one. The last one I did, I think, was $100,000. Like, I don't want to split any hairs there on that. It's not an inexpensive undertaking, but it is something that can save you a lot of heartache down the road. So
yeah. And just to add, remember, if you're paying 20 grand in umbrella premiums relative to 2,500 over a 6-year period, you're paying for the system itself. So
yeah. So
just something to note.
That's a great point, Joey. I didn't think about that. And I also, yeah, and it makes you, more marketable, as Joey said.
Yes, correct. Yeah.
When you start not ticking these boxes, it narrows the number of underwriters that your agent can put you in front of. So you can uncheck a box for them.
And just from a humanity perspective, it could save lives too.
Yes.
I mean, that's like also really important.
Absolutely. Yeah. I always get lost in the
yeah, I know, right?
So these were great questions, you guys. I recommend checking with your community manager. They should have the information from your alarm company to talk to you. And yeah, Pam, I saw that your question, if you already have the enunciator in the lobby and everything, doing the connection, I don't think is that big of a deal, because you have most of what you already need. So, okay, I don't see any more questions. I don't see any hands raised. So I'm going to go ahead and call it and say thanks again to Joey and the active participation. We always love this. So we're taking December off. Everybody gets a holiday. We're going to be back in January. I think we have discussed the topic of new year, new board, new you. So kind of just going over for, a lot of you are going to have annual meetings in the next month or two. So probably a bunch of new board members. We think it might be a good time to go over your relationship with EJF and a lot of things that we've changed and things that are now available that we didn't used to have, et cetera, et cetera. So hopefully you'll be able to join us. And thank you all again for coming.
Thank you so much, guys.